So hello and welcome to Conversations with Esther. This 13th September 2023. Karibu sana. I'll ask Magoma to pray for us as we begin. Richard. Richard, you can unmute.
Yeah. Good evening, ladies and gentlemen. Thank you very much for creating time for this particular learning session. Let us pray so that we can be able to internalize the knowledge, the wisdom, so that we can be able to apply it. Okay. In the name of the Father, I thank you very much for this particular wonderful occasion and opportunity that you have given unto us, so that we can learn from each other, so that we can progress, so that we can advance, so that we can eliminate any taxation mistakes that we are making, so that we can be able to advise and progress. I pray that you be with us, give us the wisdom, give us the energy, give us the right questions to ask at this particular moment, so that we can be able to learn very well and also unlearn. I pray this trusting in the holy name of our Lord Jesus Christ. Amen. Thank you very much, Esther. Over to you.
Thank you, Richard. Welcome, everybody. Allow me to begin with the intro side. For those that are joining us for the very first time, allow me to introduce you to Conversations with Esther. Conversations with Esther is an impact-driven media platform that informs, educates, and rebuilds mindsets to ignite ethical practices within organizations and the community. Conversations with Esther provides a professional safe space, speaking to matters affecting the workplace, social circles, and overall mental wellness. We are guided by three values: integrity, excellence, and impact. Conversations with Esther envisions a world transformed by candid conversations, respectable relationships, and the goodwill to make every effort count. Now, you can always get us on YouTube, Conversations with Esther. You can follow me on LinkedIn, Esther Katiba, and Instagram, Conversations with Esther. I will move on to the next one now. Allow me to announce this. 7th October, we have an event branded Coping with Loss and Grief at the Nairobi Children's Park, Nyerere Road. We have psychologists on site. We want to encourage you. The HR in the room, it is your mandate to ensure that employee wellness programs are driven in the workplace. We are also talking to the people on the call that have their family members and their relatives and the community at large. We will be giving free counseling in any matter, whether it is job loss, relationship issues, loss of a loved one, and all that. And we are also welcoming partners to come and join us. We want to recognize Chiromo. I know Chiromo is in the house. Scholar Media is in the house. National Youth Caucus is in the house. JCV is in the house, and those are our partners, and many more coming on board. We also want to appreciate KBC that is upholding this. And we say there are wounds that never show on the body that are deeper and more hurtful than anything that bleeds. So let us address issues of grief, loss, and grief. Now, today's conversation is understanding Kenya's new tax package. We have Fred Waswa. Fred is the CEO Octagon. We will go on, and I know Fred is in the house. We've had a conversation prior to beginning this, and this is going to be a very good debate. Allow me to read this out, and I know you can see this. Now, I picked this from ISPAC. I know they have an annual convention coming up, September 18th to 22nd. And listen to this. As taxation remains the main source of revenue for Kenya's economy, sound tax management is important for the government to provide public services to the public. According to the Budget Policy Statement 2023, the Kenyan government targets to grow tax revenues above 17.8% of GDP in the financial year 2023 to 2024, and above 18% of GDP over the medium term. The main goal of the government is to revitalize performance in all economic sectors in order to foster growth, employment creation, poverty reduction, and ultimately improve livelihoods. Now, this year's Kenya shillings 3.67 trillion budget is geared on accelerating economic turnaround and inclusive growth. The projected total revenue collection for the year 2023-2024 is estimated to be 3 trillion and Kenya shillings 4 trillion over the medium term. In addition, the fiscal deficit is projected to decline to 718 billion, that is 4.4% of GDP in the financial year 2023-2024 from a projected 840.9 billion, equivalent to 4.8% of GDP for the year 2022-2023. Now, to actualize the budget, here is the issue. To actualize the budget through the first act under the current regime, Finance Act 2023 has amended the Income Tax Act, VAT Act, Excise Duty Act, Tax Procedures Act, Tax Appeals Tribunal Act, Miscellaneous and Fees Levies Act, Kenya Revenue Authority Act, Employment Act, among others, to propose revenue-raising measures and other tax administration procedures. Now, this is just how I think I've been going through social media and a lot of posts, and it seems this is how Kenyans are feeling. You know, that feeling of being squeezed, that feeling of rocks, taxes coming down on you, tax on your back, I mean, crushed by tax. And we will get to discuss this. I know Fred will address this matter. So as I go on, allow me to bring on board Fred Waswa. Fred is the CEO of Octagon. In a minute, allow me to stop sharing here as I introduce him right away. Fred is right there, but allow me to just give you an intro of who Fred is. Fred is a founder and the Group Chief Executive Officer of Octagon Africa Financial Services Limited, a firm specializing in pension scheme administration and actuarial services, insurance broking and training in Kenya, Uganda, and Zambia. He is a seasoned pension expert with over 30 years of experience, with 20 years of this being senior management positions. Fred has greatly contributed to the growth of the pension industry. He is credited for being instrumental in the formulation of the Retirement Benefits Authority regulations in 1999 to 2001, while working closely with Federation of Kenyan Employers and the Association of Retirement Benefits Schemes in making comments and recommendations on the initial draft of the regulations. He was also appointed by the Retirement Benefits Authority to chair a committee that sets fees for service providers in the areas of interim administration, inspection, and liquidation of pension schemes. Having begun his career as a management trainee in the insurance industry, Fred has held various positions such as pension administrator at Minet, ICDC, where he was named the Best Employee of the Year in 1996 in recognition of his outstanding and innovative work in maximizing the information technology potential in the administration of pension schemes. Fred was also appointed as the first area pensions principal officer for Standard Chartered Bank in East Africa, and also co-founder and executive director of Kingsland Court Trusts and Benefits Services Limited between 2001 to 2006, where he was instrumental in establishment of a secretariat for the Association of Retirement Benefit Schemes, a representative body for all retirement benefit schemes in Kenya, which introduced compliance management of retirement benefit scheme. Finally, Fred holds a Bachelor of Science majoring in Statistics and Computer Science from the University of Nairobi. He is also a certified trustee, trainer, and examiner by the Retirement Benefits Authority, and has presented pension papers across different platforms worldwide, notably at International Conference of Employees Benefit in London, Federation of Kenya Employers, Forum Association of Retirement Benefit Schemes, Association of Pension Schemes Managers in Addis Ababa, Institute of Certified Public Accountants of Rwanda, and East Africa Community Central Bank's Pension Workshop. He is the author of Retirement Benefits Handbook, published in 2015. That tells you that we have a competent person in the room. Fred, karibu sana.
Yes.
I will give you the floor. Take over. Asante sana.
Thank you. Thank you very much, Esther, for that introduction. I didn't know that's how I am. I just thought I'm a normal human being. But let me share my screen. Share my screen. Are you able to see my screen?
Yes, we can.
Okay. So thank you very much, Esther, and good evening, everyone that has logged in this very particular platform. As Esther has mentioned, basically we would like to just have a view of what's happening around the Finance Act in terms of taxes, and especially so taxes that are what we call personal taxes that relate more to people, nature. We will also take this opportunity because I know at one particular forum somebody told me you're not talking about the tax for NSSF, so it's NSSF is also seen as from a tax perspective. I would like to just take that opportunity to be able to take through people in terms of the what's happening around the NSSF Act, which basically is increasing the cost of employment for employers, and of course increasing deductions from employees. So these are the things that we'll look at. We'll look at, and then I'll do a bit of an introduction of who Octagon is at the end, and then we'll go to the questions in that very particular perspective. I think there are a couple of changes that have taken place in terms of tax, and frankly speaking, there is a lot around tax that's happening. And sometimes I feel like we will get somewhere where we just get lost, and you just wake up in the morning and you find that tax has been introduced, another one has been introduced, and we'll just get used to that. And it's good. I think my view is that it's good to have to pay taxes, as long as the critical bit is that those taxes are used properly to be able to grow the industry, to be able to grow the economy, and therefore create more jobs and get more people to pay taxes, then which means we can then reduce the percentages in terms of how much we are paying, because then we have more people in the net paying taxes because we have the economy having grown. Now, in the 2023 Finance Act, the most spoken tax that has completely overshadowed most of the taxes is basically housing levy, or what to call the affordable housing levy, which is 1.5% of the employee's gross pay or gross salary. The levy is payable not later than, of course, 9 working days after the end of the month. So it's basically comes along together with the PAYE. And before we started this, I was telling Esther that my view is PAYE has just been increased from 30 to 31.5. It's just that the 1.5 doesn't have any relief. You know, PAYE normally has a relief, and also there's a base. There's a certain salary that you take home without necessarily PAYE. Now 1.5% is applied on everything. It does not matter whether you're earning a salary of 5,000 or whatever it is. So it doesn't have a level of relief. So which means that 1.5% is basically collecting much more than what PAYE will collect if you are looking at 1.5 as PAYE. So the KRA has tried to explain or expound in terms of what is gross monthly salary, so that it is clear on what base are we applying 1.5%. So of course, 1.5% is employee deducted, and the employer must match that with particular contribution. So gross monthly salary constitutes basic salary and regular cash allowances. This include housing, travel, or commuter car allowances, and such regular cash payments. Now that makes it even worse, because then that opens up such a regular payment, cash payment, and will exclude those that are non-cash, as well as those not paid regularly, such as leave allowance, bonus, gratuity, pension, severance pay, or any other terminal dues and benefits. So what it simply means that any allowances that are paid to staff basically are brought into the loop, in terms of affordable housing levy. So every salary that we get, cash allowances, travel or commuter, call it whatever allowance that you're looking at, it will basically be brought into. The only one that is not there, is not brought into, is non-cash, and also payments like leave allowance, which are not regular, and bonus and gratuity and pension. So of course, pension is not, and severance pay or any other terminal dues and benefits. So of course, things like basically has got eyes rolling is the new PAYE rates, which has been moved from 30% max.
Fred, I think your net went hanging, so we lost the presentation. Maybe you could share again.
Oh, okay, sorry. Let me see. Where is that? Can you see that?
Yes, it's back. Thank you.
Okay. So the new PAYE rates are basically increased from 30% to 2.5% for anybody earning a salary between 500,000 and 800,000. And anything above 800,000 is 35%. Now, of course, I know people complain this is too high, but I just realized recently that Uganda basically has a top rate of 40% of tax, and that 40% is on a salary much less than 500,000. So maybe what the government is trying to be saying, can we be able to align it to what's happening around the East African community in terms of PAYE rates? But this ideally means that anybody earning a salary of 500,000 and above, your PAYE goes up. Now we have some staff, a couple of staff who earn above 500,000 shillings in most organizations. And this basically means that there is more that is less that they're taking home. Are we okay? Esther, are we okay?
Yes, we are. We'll just mute
okay.
them. Yeah, we will.
Yeah, thank you. So that's in the new PAYE rates. Basically, are one of the taxes that has been introduced, which is effective 1st of July 2023. So I know that most of us have already applied this into our payrolls. What was a bit more painful is that the month of August, it was lumped together, July and August, because July did not take place because of the court. So people were getting much lower pays and a lot of issues around there. The next one is turnover tax for people who basically run small medium enterprises. Previously the turnover tax has been 1% on amounts below a million shillings, amounts below 0.5 million shillings. But now it has moved from 1% to 3%. So the act introduces that advice which the threshold of turnover tax from 1 million to 50 million to 0.5 million to 25 million. So what has happened is that they have reduced the starting lower amount from 1 million to 500,000 Kenya shillings. So anybody who has a business that turns up 500,000 shillings as cash annually, then you must pay turnover tax of 3%. That goes to 25 million Kenya shillings. Previously, it was 1 million to 50 million. So now they have reduced that to 25 million. So that means it's 1% to 3%. This will mean that SMEs will, with incomes above 25 million, will now be required to pay tax at the corporate rate of 30%. So we are now getting more people who will pay corporate tax, not paying tax, the turnover tax. A couple of people who are businesses who are turning over 49 million, 48 million, they were only paying 3% of that, and then they don't have to pay corporate tax. But now anybody above 25 million in terms of turnover, you must be able to pay corporate tax on your profits. That's quite something. What it means is that if you're doing a Tumba business or whatever business that you're doing, and you're getting 600,000 shillings a year, let's say 500,000, 600,000 shillings a year, monthly will be maybe 50,000 Kenya shillings, and you get about 600,000. It means that even though you make a loss, even though you're making losses, but you must pay 3% of that amount to carry as turnover tax. It's quite something. I think we should be encouraging more small medium enterprises, basically giving more people tax reliefs as they start their businesses so they can grow and employ more people, so we can have those people pay PAYE. And I think we're looking at it from the other way around. Well, the government must be knowing why they have made this change. Taxation of trust income, in terms of any amount received by a beneficiary from a trust or paid out from a trust on behalf of a beneficiary shall be deemed to be taxable income insofar as the amount is received and paid out from the income that is ordinarily subject to income tax. What happens is the trusts that beneficiary that manages funds for beneficiaries, especially so death benefit trusts. Previously, first is that the amount that comes into the death benefit trusts are taxed, at the pension scheme level or the insurance benefit that comes out as a life insurance or an individual or a personal life insurance. When it comes into the trust, that amount is taxed. But now what they want is the amount that paid out to beneficiaries. Let's say you're paying out upkeep allowances to those beneficiaries, then that is deemed to be taxable income in the hands of the beneficiaries, and that needs to be applied from 1st of July. We think that is not correct. We have basically talked to KRA and say, look, this is double taxation because the amount coming in is already has been taxed. And income is basically taxed because when you invest assets under trust, which is not necessarily a pension trust, the income on those trusts is basically taxed. So something that hopefully KRA will look at and review that. Post-retirement medical fund in terms of relief, this is a plus that the Retirement Benefits Authority and the government at large has been trying to help employers create trust funds trust funds for purpose of medical funding in retirement. So when people are saving their contributions in a retirement benefit scheme, on the side, they're supposed to be saving some extra contribution to be able to fund their medical premiums in retirement. That's the encouragement that has happened. That's why in 2019, 2018, I think so, the RBA introduced regulations for post-retirement medical funds. But then the uptake wasn't as much because there wasn't a relief, there wasn't a motivation for this. Now they have provided that motivation that if you make a contribution of up to 5,000 Kenya shillings into a post-retirement medical fund, then that 5,000 is given tax relief. No pay tax relief of up to, I mean, they have up to 15% of the contribution of or 60,000 shillings, whichever is lower. Then that's the amount that's the amount that you get tax relief on. So the aim of this relief is basically to encourage resident individuals to sign up and contribute to post-retirement medical funds, so that we can have sufficient money in retirement to pay for medical care, which is the biggest cost for people who are retiring. I think it's a good idea. The only challenge is if it's not made compulsory, I guess that nobody will want to save money. People, even we have tax reliefs on life insurance products. For example, individual ordinary life policies have a tax relief if it's an education policy. But how many people take that just because they want to get that tax relief? Normally it's a challenge. So we need to push a little bit of this into making sure that everybody can be able to save a little bit for purpose of medical funding. And then exemption from income tax. Exempt from income tax in terms of the income. So apart from the contribution, so when the contribution comes through, we'll get tax relief at the contribution level. When the amount is invested to be able to pay for the medical at the end, then you will get a tax relief on income that is being earned on the funds as they are invested. Retirement Benefits Act number 3 of 1997, section 25B of the Act. The Act has amended the requirements for a registration of administrators by reducing the amount of paid up share capital owned by Kenyan citizens from 60% to 33%. Previously, we have had a sort of an entry barrier for international investors in the space of scheme administrators. That for you to set up a company in Kenya to be able to do a scheme administration as a foreigner, then you must have a local person. You must have a local person owning 60%. So the person coming in can only own 40%. That was what it is, but now that has changed. A local person is allowed to own up to 33% only, so which means the international investor can own up to 67% of the business in this very particular space. Section 38 of the Act has exempted funds that are exclusively set up for the purpose of investing in Sharia compliant funds from investment guidelines. Of course, you know, the Sharia compliant funds basically are they're not supposed to earn things like interest. So the investment guidelines that are provided under the Retirement Benefits Act provides funds that are interest based. So what they have said, then funds that are going to be invested in Sharia compliant funds will be exempted from investment guidelines provided under the Retirement Benefits Act, so that they are able to be invested only in assets that don't have investment income or interest, in that very particular space. The requirement for trustees to maintain and avail records to the Commissioner. The Act has amended Section 23 of the Tax Procedures Act to require a trustee resident in Kenya who administers a trust registered in Kenya or outside Kenya to maintain and avail to the Commissioner records required under a tax law, whether the income generated is subject to tax in Kenya or not. This is basically for the trusts, which are not necessarily pension trusts. The government allows people to set up trusts for various. You can have a life trust. You can have a death benefit trust, all these kind of trusts. But most people set up life trusts to be able to put in assets for their generations to come. Now, previously, there was no requirement for returns that need to be made for trusts that are not necessarily based in Kenya, but income is being earned in Kenya. But now that is a requirement that you must have returns made in Kenya, even though the trust could be elsewhere, but the income is being earned in Kenya. Tax amnesty, which is important. The Kenya Revenue Authority would like to notify taxpayers that the Finance Act 2023 introduced a tax amnesty on interest and penalties on tax date for periods up to 31st December 2022. The tax amnesty will run from 1st September 2023 to 30th June 2024. It's a good thing for us that if you're not able to pay your taxes as of that 1st December 2022, and you want to pay them today, then you must apply for tax amnesty. If you pay those taxes and you did not pay interest and penalties, you then basically are able to get that penalty and interest. As long as you are able to apply, then you get that interest and penalty waived. So that amnesty is good for us, for people who have had challenges, especially during COVID. People had challenges of paying those taxes. So ideally, that's around the tax. The other bit that is circulating in social media is proposed motor vehicle circulation tax that will target Kenyan car owners at the point of acquiring an insurance cover. I was just looking at it and wondering whether this is coming back in terms of road levy, which we used to pay when we were renewing our licenses for roads, for the cars. The tax will be payable annually after gaining full ownership of the vehicle and will vary depending on engine capacity. Now, this is basically things going around the social media. It hasn't come through yet, but they always say where there is smoke, it could be likely that there could be a fire. So these are things that we need to look at. I think also we have had yesterday's paper, there was all this area about taxes that have been increased by the Nairobi City Council. Which is, in my view, is just quite high. Cost of cutting a tree in the county varies from 1,000 to 8,000, depending on the size. I mean, just to cut a tree, we must pay city council that level of money. I think things to do with vendors in terms of doing business in Uhuru Park, that has also been changed. Live music in Uhuru Park, that has been changed. That has also been changed. Cost to 100,000 shillings up from 5,000 per day. New trade license charges for supermarkets, that has also been increased. Annual trade licenses for international airlines, of course, that has also been increased. Traditional caps to pay 3,000 shillings per month on street parking. Caps to pay another 5,000 shillings for pick and drop, especially now Ubers and all these online vehicles, service vehicles for taxis. We have digital and traditional cab operators, basically the Ubers and all that, will have to pick and pay. They have to pay 5,000 Kenya shillings. A tax registration, for taxi registration fee to be paid by both digital and traditional cabs is 1,500. And the cost of preaching at City Park is now 1,000. And border borders to be able to drop passengers and deliver goods in town is 1,000. So of course, deliveries, some of us who have deliveries will have to look at that. And the cost of preaching at G1G now, there is a cost for you to be able to speak to people about God. There is also a whole discussion around treasury around thinking about increasing proposed VAT from 18%, from 16% to 18%. I know that East African community countries basically have 18%. We do 16%. That discussion is there again. We do not know whether it will come, but something that we need to watch, that we may increase tax VAT from 16 to 18%. So of course, if that happens, it's going to increase the cost of goods substantially, and that will hit quite a number of us in terms of cost of living. So I will move on to the NSSF Act, which is basically administering the Act. NSSF Act, ideally the objectives of the new fund. NSSF was set up in 1965-67. And it basically provided that one should pay contributions of 5%, 5% of salary employee and 5% of salary employer. The only thing they did was to put a cap at then was about 40 shillings per month for both employer and employer. That was increased in 1978. to about 80 shillings per member. I mean, 80 bob by member and 80 bob by employer in 1978, and then in the year 2001, it was increased to 200 shillings. So a 200 employee and 200 employer. Now that has been a challenge in terms of two things. One is the adequacy of the benefit. The benefit has been quite low. If somebody has worked for 30 years, 35 years, you go to NSF, you get 150,000 Kenyan shillings, get 140,000 shillings. Really, that will buy you a pair of shoes, and you have your pension done. Now, that is the biggest challenge. So this new fund, what it does is that it's increasing membership coverage for the Social Security scheme. Previously, the previous act had provided that companies that have less than 5 employees don't qualify. It's not mandatory, but anybody above 5 employees may. But now anybody that has 1 employee. So if you have your staff. If you have your staff in your house, house helps, you are an employer in the eyes of NSSF, and therefore then you must register as an employer, and your house help must register as a member, and then be able to pay contributions based on the new rates. And the thing also I mentioned about adequacy of the benefit, which basically it increases. Now the contributions are not necessarily based on a fixed amount, but are based on a moving base, which is the minimum wage and also national average earnings. So it provides, the new fund provides for opt-out of tier 2 contributions, which we'll be able to look at in a while, and provides a vehicle for self-employed persons to access Social Security for themselves and their independence, and operate and manage a scheme that is value adding to its employees. Things that have happened around the new fund is NSSF subject to oversight and regulatory compliance to the RBA Act and regulations. Of course, NSSF has been under the RBA regulations for a while now, and there is something that has happened around that just because of that, which we should be able to give them credit for. There is a lot that needs to happen, basically, but I think something's happening around there in terms of compliance. Segregation of the old fund and the new fund, the new pension fund. So the old fund is closed. So people don't lose out on those benefits. But what happens is those fund, the money will grow with interest until one retires. When you retire, you'll get money from the old fund as a provident fund, which is cash, and the new fund you'll get it as a new money from the new fund as a pension fund, which is basically monthly income that needs to be paid. Board composition now is tripartite arrangement plus independent trustees. That's also a new change. Financial statements be published within 6 months of the year, and triennial actuarial reviews and annual general meetings in terms of they are now compulsory and they must be done. Membership of the new fund, as I mentioned, all employees above 18 years and subject to provisions of the Employment Act must be members of the scheme. Current NSSF members for the Provident Fund, except the voluntary contributors, become automatic members of the new fund. So you don't have to basically apply for membership in the new fund if you are in the old fund. And then basis of contributions, statutory contributions are expressed as a percentage of pensionable earnings. And then upper earnings limit is 4 times national average earnings. So they're not interested in your total salary. What they're interested in is there is an upper limit, which is the 4 times national average earnings, and the lower limit, which is the minimum wage. So therefore, pensionable earnings is the lower of the members' monthly wages and the upper of the earnings limit. So whichever is in between there is what's pensionable earnings, and that's what the percentage is supposed to be applied on. Levels of contributions is tier 1 is contribution earnings up to minimum wage, so tier 1 is contribution earnings up to minimum wage. So minimum wage, for example, is, let's say it's 15,000 or whatever it is. So contributions of tier 1 will be the contribution, the percentage will be based on minimum wage. And minimum wage moves every year, declared every year by the government. Tier 2 contributions will be on earnings between minimum wage and the earnings and the earnings ceiling or upper earnings limit. So minimum wage and upper earnings limit is where tier 2 contributions will be deducted from. So tier 1 to be paid directly to NSSF, and tier 2 will be paid to NSSF directly until as and when an employer has received approval for contracting out. So tier 2 employers are allowed under the Act to contract out. Contracting out, we'll be able to look at that. Is basically instead of paying to NSSF, you pay to a private pension scheme, which is either yours or an umbrella fund that has been set up for that for a particular purpose. In terms of key definitions, so lower earnings limit is average statutory minimum wage, which I have mentioned. Upper earnings limit is 4 times national average earnings. And then pension of earnings is the lower of the members' monthly wages and the upper earnings limit. So let's look at the tabulation in terms of contribution. So phasing of tier 1 contributions. The tier 1 contributions are phased out in the next 5 years as fixed contributions. And they are fixed based on year 1 on 6,000 as the lower earnings limit. So anybody who earns a salary of 6,000 Kenya shillings and below will pay 360 Kenya shillings as employee contribution, which is 6% of 6,000, and then employer matches the same contribution. Next year, from February next year, it will go up to 7,000. Then the following year, 8,000. The following year is 9,000. In the 5th year, it will be based on 6% of minimum wage prevailing in the 5th year. We've just taken here an example that hopefully it will be, maybe it will be 15,000. That will be 9,000. So these contributions are tier 1 contributions, and they must be remitted to NSSF. So if nothing else changed, then this should have basically contributions replacing what we have always had, which is 200 employee and 200 employer. However, there's another tier 2 contribution, which is additional to this. Why? Is because the feeling of this contribution is not sufficient enough to be able to have somebody's benefit at retirement. So they said, let us have another level of contribution, which is phasing of tier 2 contribution, which is 6% of pensionable earnings, which is above the lower earnings limit, which is the minimum wage. Yeah, and the upper earnings limit, between the lower earnings limit and the upper earnings limit, which is the national average earnings. So the upper earnings limit is basically taken as that 6,000, and that's the national average earnings as 2013, when this bill should have come, when this act should have come in place, but it didn't because of the court case that took us almost 10 years to be able to get out of the court. So the same tabulation is being used starting from this year for the next 5 years. So first year is 50% of national average earnings, so which means it's 50% of 36,000, which is 18,000. So 18,000 is our national average earnings as our upper earnings limit. We remove it from our lower earnings limit, which was 6,000, so we get 12,000. So 12,000 by 6% gives us 720. That is the employee, and then the employer matches the same contribution. That is year 1, and this is the current year that we are running at the moment. Come in February next year, we will apply the one-time national average earnings, which is 36,000. And therefore, we'll take 36,000 minus 7,000, which is the year 2 of the lower earnings limit, and then get 29,000, and then remove. Then take 6%, which comes 1740, match with 1740. So the following year it will be twice national average earnings, which will be 72,000. Then following year will be 3 times national average earnings, which is 108. The following year will be 4 times national average, which is 144. So the 5th year, we're assuming it will be a different national average. It will definitely be, because every year national average earnings is declared by the Kenya National Bureau of Statistics. Maybe then it will be 50,000, which means that then the amount that will be upper earnings limit will be 4 times by 50,000, which is 200,000. So the 6% will be based on that particular amount in year 5. Now, this tier 2 contribution is what is allowed for contracting out. You can send to NSSF, we don't have a problem with that, but you are also allowed to send to a private pension scheme once you get a contracting out certificate from the Retirement Benefits Authority, which is issuing these certificates. So considerations for HR is staff contracts. Of course, staff contracts are critical at the moment. Every contract, whether you are an intern, whether you have contract staff, whatever staff they are, we must have that earnings in terms of that. The other thing that needs to be looked at is the issue of gratuity under staff contracts. If you have a gratuity scheme that is running, NSF doesn't care. It means that you may have to look at that gratuity and say, how do we integrate that gratuity into the contribution so that you don't have to increase the cost of employment. So of course, review the employment costs and overall cost management of the business, and integration of contributions to retirement savings for staff. This is where you have a scheme running today. You had a scheme that was running before NSSF came in, a private pension scheme, or you are in an umbrella fund, and maybe your contribution was 5% and 10%, or you are doing 10% and 10%. Or for parastatals, most parastatals are doing 10% and 20% contributions. And you also then have to add on the 6% employer and employer, which is going to be basically 6% of some of those especially lower earning staff. It means that if you are doing 10% employee and you add on, you're gonna ultimately have 16% employee, and then 20% you will ultimately have 26%. Now, that is going to be a bit of a cost. So what employers are doing is integrate that. So whatever contribution that is supposed to be paid to NSSF comes out of the contribution that's currently running. So if you are running at 10% and 20%, out of your 10, you remove 6%, goes to NSSF. So NSSF tier 1 goes to NSSF, tier 2 remains in the scheme as a contracted out contribution. And then now, if you are doing 10, there's another 4, which we're calling tier 3, and that basically runs across. The same thing happens with employer. That means that you still have to retain your current cost of employment in terms of paying to pension scheme, but then you make yourself compliant by making sure that contributions are allocated in terms of tier 1 going to NSSF, tier 2 remaining in the scheme but is contracted out, and tier 4 and tier 3 is basically the contribution that has been going on in the previous. A little bit about Octagon, then we can go to questions. And questions is we are an award-winning company. We basically, as Esther mentioned, we are in Uganda and Kenya, in Zambia. We're basically just setting up in Tanzania. Currently, we've got a strategic partner there now. We are in 4 divisions in pension and management, which is basically pension administration and consulting. We do insurance broking, training, and actuarial services. Our vision is to enrich lives through innovative financial services and solutions. Our mission is to safeguard financial future of our customers through lifelong learning, risk management, and retirement solutions. As mentioned, we provide employee benefits administration and consultancy. We have an umbrella fund, and if you want to contract out, you can contract in our umbrella fund. We have a personal pension plan. You are self-employed, you can be able to save for your retirement. Income drawdown funds across the 3 countries, post-retirement medical funds. We have trust funds for investment consulting. We do actuarial evaluations for gratuities and investment policy statements. We do insurance broking and training, which we do under the Institute of Pension Management as our subsidiary company. We are an award-winning company. We have awards. We have won awards over the last 3 consecutive years for top 100 and innovation that we won for Pension Summit in Switzerland. Our board of directors, we have Richard Omila, we have Caro, we have Dr. Kasozi, Julius Mwangi, Shapiri, Maria, Peter Kello, Kefa Nyakundi, and it's our management team that we get to provide a service to sign up for our clients. Thank you very much. I think I've come to the end. Esther, if there are any questions, then we can pick them up and see how much we can answer as much as we can.
Wow. Thank you, Fred. I know that is that's heavy information. I see Magoma there. Richard has already decided to unmute, and I'm seeing others have decided to put their cameras on so that they will come straight to you. I told you today, just be ready. Just be ready. You will pay for the government. Let me first ask the ones that are on the chat, then the rest. Steve and Richard, I know. There's
Okay.
Esther here that is asking, is a company required to pay an SSF for contracted individuals like repairmen, carpenters, electricians, putting in mind these are not employees of the company. They are just called on to make minor repairs?
Okay. Can I answer one as we go? Because
Yes.
I don't have to down again. Yeah. No, not contracted out. You know, if you are on a contract of service, so you are paying these people a fee for providing a service. That's not salary. That's not on payroll. So then you basically are not paying NSSF on them. But if they are on contract of employment, which means you are paying them a salary, then you must apply NSSF on those staff.
Good. The next one is Alexander is asking, is a company required to pay housing levy for casual workers, or they are exempted?
What I understand is that every worker is supposed to pay, every employee is supposed to pay housing levy. I'm not sure about casual workers, but I think they are described as under the Employment Act as employees, and therefore they should be able to pay 1.5% housing levy.
Okay. Is there an option of contributing tier 2 to an SSF for a company who has opted out, but some of the employees prefer to remain under the NSSF on personal reasons?
No. The person who contracts out is not the member. The person who contracts out is the company. So once the company has contracted out, then all employees must follow suit where they are going, where the employer is going. If the employees decide, if the employees decide that they don't want to move out of NSSF, they must convince the employer not to contract out, and then which means all the money goes to NSSF. So as employees, you don't have that power under the Act to contract out. It's the employer that contracts out. So once he has done that, then every employee must follow suit.
Good. I know Magoma is waiting. Magoma, Steve, you want to speak?
Yeah, thanks. Thanks, Fred, for that insightful. Some of us who are not tax consultants are really getting a lot of insight onto this NSSF thing. To be honest, at my end, I was really confused. So that tier 1, tier 2, and the upper limit and the lower limit was too complicated. So my question would be, at what point, so do we depend on the Kenya Bureau of Statistics to determine that, what you call the, let me just call the correct, how you called it, the minimum wage, not the minimum,
national average earnings.
Yes, that one. So
yes.
As an entity, where do we get this data so that we can say now this is the national average earnings, and then how we peg our calculations on it?
You know, there is a document that the Kenya National Bureau of Statistics issues every July. I think around July or April. I mean, they actually launch it. It's the economic survey, is that right? In the economic survey, that is where the statistics that comes from. I think RBI are going to be basically providing this kind of information every year and say, look at the national average earnings is going to be X, and therefore that's the amount that we'll be using. But it's normally a statistic that comes into the economic survey in that respect. So, for example, when we go to year 5, year 5 will be starting in February 2018, yeah, around there. I think 2028. What it means is that the economic survey that's going to be launched in 2027 will have the national average earnings that will be applied in 2028 as the upper earnings limit.
Well, thanks. I now understand. Thanks.
Thank you. Thanks, Richard.
Good. Magoma?
Thank you very much, Mr. Waso, for that very elaborate presentation. I have a couple of questions which I know get into the nerves of people who pay taxes and HR people. One of the questions I want to ask is the night out, the 2,000 shillings, which is not enough. Why is it being taxed? Two, supposing I'm given airtime of 6,000, Bob, why should it be taxed? Why should it be loaded on my pay and yet I'm using it for company programs? How do we treat, for example, I get a loan from my employer, should it be taxed? The other question is, supposing I win an award, Octagon has won so many awards. Now, supposing an employee won an award and it's given 20,000 shillings, should it be subjected to taxation? Thank you very much, Mr. Vas. This is Richard.
Thanks, Richard. Thanks. I know, Richard. Richard, I think the description of the base on which 1.5 affordable housing levy is supposed to be applied is ideally a regular income. So if you are winning an award, that's not a regular income. It's like a bonus. You get it? A bonus, gratuity, pension, leave allowance. These are not payments that come regularly, and those are not levy based. So you don't be able to pay levy on that. But if you the night out, and night out is not a regular payment unless the night out is going to be, you pay people night out every day, every month, which I don't think so. The night out is somebody going out today because they're going to be to whatever it is. That's not supposed to be subject to pay to levy. It's the only amount that is subject to levy is those are regular cash allowances. Of course, basic salary plus regular cash allowances, which is travel, commuter, car allowances, and those kind of things like that. When you talk about travel allowances, there are people who are given travel allowances or on a regular basis because the marketing, they say marketing staff. So that becomes a regular pay that basically then 1.5% has to be applied on it. And I think KRA what it's trying to do is just to make sure that you don't utilize those, you don't hide the amounts into those regular payments, like travel, like commuter, like car allowances, and then you not be able to pay 1.5%. So the only thing is non-regular payments are the ones that are exempt from the 1.5% housing levy.
So Richard, your questions have been answered, all of them?
Yeah, all right, thank you.
Any other question? Let me check on the chat. Anyone else that would want to unmute? In instances where employees are paid bonuses every year, will this be subject to 1.5?
In instances where employees are paid
bonuses every year, will this be subjected to 1.5?
They have said bonus is not subject to 1.5. Now, I have a feeling that that's going to change very soon, because what people are going to do is to pay people bonuses, pay people through bonuses rather than salaries, so they can avoid 1.5. Yeah. But the clarification from KRA is that bonus is not subject to pay to a housing levy.
Okay. So for those who are asking for the slides, we are recording this live, so you can always go back to the recording and watch. Any other question? Anyone else with a question? I know we are 3 minutes past our time. Fred, maybe you could put up your, Francis, you have a question? You've unmuted. Francis Okongo, you're unmuted. Do you have a question?
The market forces will fix that.
Okay, So Fred, you could possibly put up the slide with the contacts for Octagon, I think, so that as we close.
Okay.
So let us feel free to keep in touch with Fred and with Octagon. You will get the advice you need, definitely.
I think I can just put my contacts in the
Yeah, just put
chat.
your contacts in the chat, then they will pick that. So also continue to subscribe to our YouTube. You can watch this session and our previous sessions on our YouTube, Conversations with Esther Katiba. So we've shared the YouTube link there. So yeah, yes, Fred has put his email there, fred.waswa@octagonafrica.com, fred.waswa@octagonafrica.com, 0724471821. You can pick it from the chat and kindly feel free to contact him. Thank you, Fred. I know we made you change your flight.
That's okay. Thank you.
But I know you've been of help to very many people, and thank you for that sacrifice. Thank you everybody for joining us. I believe we have learned enough. Let's keep in touch with Fred. Let's keep watching and joining in for the fireside chats. We do this every Wednesday, 7 p.m. to 8 p.m. Asanteni sana. Thank you and God bless you. Thank you, Steve. Thank you, everybody. And bye-bye. Have a good night.
Thank you very much.